Odysseers! Mike Martin's here with the Mike Martin channel. Thanks for being part of the channel, liking, subscribing, and watching some old videos. Apparently, a lot of my old videos from 4, 5, 6, 7 years ago on real estate, finance, inflation, the mark of the beast, whatever we talked about, it's actually getting views. I'm getting views on YouTube now. I don't know if they unlocked my channel or what they're planning on doing, but people are going to see what people said about this stuff 5, 6 years ago. Well, we're here. And we have something to talk about here. It's from our friends over at Better Dwelling. Canadians are more indebted. Low rates did not improve from improved real estate affordability, says Bank of Canada. It's from our friends over at Better Dwelling. And look at the gorgeous weather we're having today. We had a bit of snow the other day. It was a little cool. And it's going to get up to the plus 13s and 14s this week. So we're not in winter yet. We got a bit of snow, but winter's not here yet in Merritt, BC. Should come first week of January. Anyways. Okay, so here we go. After decades of telling people that low rates make housing affordable, remember that? How many episodes of Trends in the Housing Market did we do talking about housing affordability? Lowering rates, it's just a band-aid. It's not going to fix the problem unless wages keep up with the cost of housing. Housing market should be tied to wages. Now, wages need to be tied to housing market. When there's a low influx of jobs or layoffs, then the price of housing should, in turn, correct on its own, with defaults and then in turn raising interest rates, in turn burning off the bad debt, so to say. Research shows, let me zoom that properly, decades of low rates did not make the housing affordable. In fact, it had the opposite effect, increasing the size of mortgage debt. Real estate markets absorbed the increased debt capacity as households began borrowing more. Okay, remember? My house is an ATM machine. People using their homes and equity in their homes as an ATM machine. You got to pay it back, regardless of what happens. Oh, I'm going to make more in the future. This way, borrowing this money is going to be cheaper for me because you're paying interest. You're paying VIG on that money, right? So there it is. Mortgage debt service ratio, the DSR. Let's start from the top, folks, that need a quick refresher on debt terms. A mortgage debt service ratio, I call it a TDS, total debt service ratio, is the share of disposable income spent paying a mortgage when the mortgage DSR falls. Less than income is dedicated to paying a mortgage debt. If the ratio rises, the share of income is going to debt repayment grows. So the income going to debt repayment grows. So here it is, guys. Let me just show you right here real quick. So I've made several videos of this. This is called the Mortgage Qualifier tool. You could find them. All banks have them somewhere in their websites, where it actually you put the income, what you make, and what you pay, and whatever's left over. It should tell you what mortgage payment you could afford and how much you should be able to afford, and you should also adjust it with the rates going up, percentage points, down payments, and annual rates. So if rates go up, how much more do you need to make to cover your nut? And that's very important. We made several videos on mortgage total debt service ratio calculators. So here it is. There's a couple of issues. The rising mortgage DSR levels can create beyond affordability. Every point spent servicing debt is capital diverted from other areas. That's very important. Food, right? Fewer dollars spent in general economy means slower growth and smaller investments. Again, small businesses not opening as much because more people are investing in homes. While expensive housing is a great way to produce short-term wealth, it becomes a long-term liability. And that's where we're going into right now. The other issue is mortgage DSR numbers seem small. We always receive an email after publishing data from the industry. It usually reads that something along the lines of it's single digits. That's not enough at all. Everyone could pay that easy. True. It would be easy to pay a single digit DSR. However, this is an aggregate number with the whole population. People who own their homes outright, and renters drag down the average. So people with $600 a month mortgages on homes they bought 20 years ago. Yeah, keep that in mind, guys. You got to get the aggregation in there to actually make a difference so you can see what the numbers really are, right? When looking at national mortgage DSR, you're not looking at how it impacts a single household. You're looking at how it impacts the country and how it's changing for the mortgages. DSR to change rapidly means people are borrowing a lot faster. Just a small pool of recent buyers needs to borrow so much, it skews the whole national trend. Remember, we did a whole video about seniors and older people taking on more mortgage debt, more debt to basically keep their bubble going, to keep their debt going. Because a lot of people, again, have been using their homes as ATM machines so they could basically eat off the equity and not save it for a rainy day. So Canadian mortgages, DSRs, have been rising over the past 20 years. And since 2000, again, we've been saying this has been happening since 2000, but it really started taking off around 2010. Canadian mortgage rates have declined dramatically along with interest rates. The Bank of Canada estimates the average rate for a 5-year fixed insured mortgage has gone from 8% in 1990 to 2%. So this is the Frankenstein monster we created here. The Frankenstein monster we've been talking about here. We created this monster and now we don't know what to do. In Q2 2021, the cost of borrowing dropped by 75%, which in theory should have made it much more affordable to buy a home, except your average millennial can't tell that's not what's happening. Like Christopher Columbus of real estate, the Bank of Canada has discovered housing is more expensive. The mortgage DSR went from 5.39% in 1990 to 6.51% in Q2 of 2021. Golly gee whiz, that's more than a point higher. Canadians borrow more debt when rates fall. Again, it becomes cheaper to borrow money, so people borrow more. But if you can't invest it properly to get a good percentage rate return, then you're kind of screwing yourself, right? Canada's central bank has found more people borrowing more when rates are cut. As we've discussed recently, the ratio of mortgage debt to gross domestic product, GDP, was 38% in 2020. And in Q2 of 2021, it reached 71% from 30%. Woo! Mortgage debt grew nearly twice the speed of the economy. Again, mortgage debt grew twice the speed of the economy. And that's why countries like Canada, Australia, New Zealand, the UK, that's why I knew something big was going to happen down the line in these countries. Because they're selling off to the highest bidders. A lot of laundered money coming in from China. A lot of people moving their money out of China after that Xi Jinping or whatever announced himself as Emperor of China a few years back. That's become a huge issue, right? So a lot of people want to move their money. I would want to keep my money in a country where you have an emperor. We just had a throne speech here not long ago. Anyways, what does this mean? It's hard. It's a hard word. It's a hard word. It more elegantly than the Bank of Canada did. When interest rates fall, many households simply adjust to borrowing more. That's it. You borrow more. The decline is mortgage rates over 2 decades has been reduced. Servicing costs has led to higher mortgage indebtedness. So more free money. Here you go. And more borrowing. And this should be your outstanding GD. There it is right there. So more borrowing. The myth of falling rates improving household affordability is a total myth, guys, by the way. We debunked that on the channel. The common mantra repeated is that lowering interest rates improves affordability at a high level. This makes sense. Lowering interest rates costs make it more affordable to carry debt. The catch has always been as long as the size of the debt stays similar size or smaller. So they're always, like right here, this is the best part right here. The Household Budget Act as friction for home prices, slowing down growth. It doesn't matter if you say your home's worth $1 million. If you only qualified a home buyer only as $900,000, the seller either has to accept the qualified buyer's price or not sell their home. You can't get blood from a stone. Lowering rates expands budgets, allowing households to borrow more money without higher income after decades. So basically, instead of wages going up adjusted to the cost of living, they're lowering the price of mortgages on an invisible loan they're loaning you that the bank probably doesn't even have in its single location, has in its vaults. That's kind of really tricky-some or weird-some, almost like put my tinfoil hat on here because I'm going kook here. And then low rates exuberate a shortage of inventory. We went through that many times. So there is the whole issue where low rates attract investors. Low rates lower bond yields, where investors traditionally look forward to a fixed income by driving their returns below inflation. This diverts investor capital into alternative assets. Right there, housing being an alternative asset for those that need a spoiler. The Bank of Canada is going through a renaissance. Discovering aspects of behavioral finance this month. Its low rates didn't improve affordability a few months ago. Easy credit leads to higher home prices, whether they're willing to use any of the information to create a stronger policy is a big question. So far, the governor of the bank's research have been on a very different page. That is it right there in a nutshell, folks. And that's what's happening. They've been lowering rates to these historical levels. We created this Frankenstein monster and these fake economies with our fake healthcare system and our fake journalists and our fake... If you want to get into more fake stuff, check us out on Mike in the Night on Odyssey. What a gorgeous day here in beautiful Merritt. I've had my door open all morning. It snowed the other day, but it's going away. We don't really get into winter here. Our winter season usually starts first week of January. Let me know what you guys think in the comments below. Look forward to reading what you guys have to say about this. A lot of people, and the reason for this video is a lot of people are on the hook. A lot of people, oh, Mike, I'm renting. I don't have to worry. Yeah, you're renting. You're probably in a property that's owned by one of these yahoos that bought it at the top of the market and then put 50% down. So if the rates do adjust or they lose their job, they could kind of get by or find a way to get by. Let me know what you guys think. Lots of love. Be strong. Guys, mtg.toys. I want to thank everyone that's been buying board games and shipping them to all over the States, all over Canada. If you're in North America, please buy a board game. mtg.toys. That's it. That's the URL. Buy a board game. So many good games here. Hundreds, if not thousands of individual board games. Sit around with the family. Have fun. Enjoy. Talk. Have a few drinks. Coffee, tea, whatever. Lots of love, guys. Mike Martin's here. I have spoken.